Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager in Liechtenstein at Incrementum AG. He's wrote an annual in-depth gold report called In Gold We Trust for 9 years now. And he also occasionally writes articles on the Mises Institute website. Ronald-Peter Stoferle, thank you for joining me.
Hi, Jason. Thanks for having me again.
Yes, I actually missed your book that you released in English, Ronnie, in late 2015, entitled Austrian School for Investors, Austrian Investing Between Inflation and Deflation. In your opinion, then, how do you think learning the Austrian School of Economics made you a better investor?
I think understanding the Austrian school, it doesn't necessarily make you a better investor, but it adds very, very strong tools to your toolbox. So I think grasping the consequences of the interplay between monetary inflation and deflation is really crucial for prudent investors these days. I think understanding our monetary system, how inflation spills into the system, differentiating between monetary inflation, asset price inflation, and price inflation is crucial. And you know, with the book on roughly 400 pages, we basically wanted to lay out our intellectual framework, and we're glad that it's such a success. I think the beauty of the Austrian school for an investor is actually the fact that we're to understand that we're not in a cyclical crisis, but in a systemic crisis. And most of the problems that we are having at the moment basically go back to our monetary system and can be explained by our monetary system. So understanding the Austrian business cycle theory that causes the boom and bust cycles, the Cantillon effect, which basically describes the wealth transfer through monetary inflation. All those things are very, very important to understand at the moment. And as you might know, followers of the Austrian school have been very, very successful in anticipating really major economic events like the Great Depression, the housing bubble, and so on. But when it comes to timing, the followers of the Austrian school are very, very modest. They say basically it's impossible to make any timing recommendations because you cannot put human beings and the economy into models, even though mainstream economists think so. So in a nutshell, I think the Austrian school adds quite a lot to your skill set. I think it's highly interesting, highly relevant, but it doesn't necessarily make you a great investor.
I think when the more Austrian School of Economics I learned, it taught me, more logic and common sense and to look at kind of both sides of a problem. But it also taught me to look at whether it's a commodities market and whether, China is doing all this really artificial infrastructure projects. There's artificial demand for it. I'll give you an example. When copper was over at $4 a pound or higher a few years ago, I was like, well, this is unsustainable how much China can keep with all this demand for iron ore, steel, copper. They can't keep consuming this and building, all these infrastructure projects and cities, and they're not going to be able to consume this demand. And China, I think, was 50% or more of all of those markets. So I said this was unsustainable. So that's something, whereas if I had not learned Austrian School of Economics, and I had just looked at regular supply-demand numbers of copper, I wouldn't have assumed that demand was artificial like it was. So, having an Austrian framework, I think there is opportunity, but you really have to assume that, like, the governments are going to cheat, there's going to be intervention or market manipulation, whether it's by the private sector or large investment bank or whether it's by a government.
Absolutely. I mean, I think that Jim Grant basically summed it up pretty well. He said that Austrian theory is giving him an edge. When you have a theory to work from, you avoid the problem that comes with stumbling around in the dark over chairs and nightstands. At least you can begin to visualize in the dark is crucial, and the future is always unlit. But with the body of theory, you can anticipate where the structures might lie and so on. So it allows you to step out of the way every once in a while. And this is crucial these days. But for example, with China, from my point of view, they're basically the world champions in monetary inflation. And I would have thought that this would be collapsing much earlier, but sooner or later it will happen. They have been acting much more aggressively after the great financial crisis. Their QE program was based on the GDP of China, roughly 3 times bigger than in the US. So in China, they are just building massive overcapacities over the last couple of years, and sooner or later it will collapse, and the later it collapses, the worse the bust will of course be, and this will have enormous deflationary consequences. So I totally agree to Peter Schiff. He says that in fact all great hyperinflations, they result from a deflationary bust that the government attempted to prevent from happening by printing money. And I think it will be quite similar this time again. So therefore, as an investor, I think it's really crucial to prepare for both extreme scenarios, extreme inflation, but also extremely deflationary environments.
And do you think that central banks are some of the main causes of both, free market forces, markets clearing? They cause, I think, asset bubbles and credit bubbles. They either reflate them or create new ones. And then I don't think, in my opinion, Ronnie, that hyperinflation can be caused by capitalism in the free market. I think the only way hyperinflation can be caused is when a government and a central bank basically totally destroys the currency, and then a bunch of people eventually figure that out.
Absolutely. I totally agree. But I think we should not only blame central banks for all the mess that we're in, because in fact the majority of our monetary aggregates is not controlled by the central banks, it's controlled by the commercial banks. So what the central banks basically did with their quantitative easing, they tried to manage the deflating broader monetary aggregates, because credit growth was collapsing, banks were on the verge of bankruptcy, so therefore the broad monetary aggregates were just collapsing, and this is the reason why central banks just expanded their balance sheets. And many people said, having a look at the monetary base in the US that was going crazy, of course, many people said, okay, this will happen immediately. This will lead to hyperinflation. What they did not understand, and I think this is also where the Austrian school comes in, they did not understand that, as I've said, the majority of our monetary aggregates is actually created by commercial banks, by expanding credit. And this leads me to a very, very important point. At the moment, money supply growth is collapsing. It dropped to 108-month low. And having a look at the money supply, the real MZM, so the very, very narrow aggregate in the US, for example, it dipped to 2.5% recently, which is the first time since 2011. So this makes me extremely cautious. We're seeing that credit growth is very, very sluggish. We're seeing that central banks are becoming more hawkish. The Federal Reserve talks about quantitative tightening. I think that's a bad joke. But still, a combination of central banks becoming more hawkish and credit growth collapsing, that's basically the recipe for a big catastrophe.
I think it's unprecedented. We haven't really had this in decades, is the amount of collusion and cooperation with these large central banks in the G7, the Bank of Japan, the European Central Bank, the Federal Reserve, the Bank of England. Normally in the past they have colluded. It was right after World War I. It was right around Bretton Woods. So they've done this before in terms of, taking turns, either raising interest rates or doing QE or expanding their balance sheets. But did you think, Ronnie, that after the 2008 financial crisis that we would see the Bank of Japan and the European Central Bank have expand their balance sheets to the point where they would have even larger balance sheets than the Federal Reserve?
Yeah, basically, I thought so. The thing was that, as always, the US reacted much more quickly and more pragmatic, while for the ECB it took much longer to introduce any QE, because some people, especially from the northern countries, still kind of thought or hoped that the ECB was created like the German Bundesbank. So they were really in favor of a very strong euro, while nowadays it's basically what Jim Rickards wonderfully describes in his book Currency Wars. Everybody wants a weak currency. Now it's the dollar at a euro 120. There's increasing pressure on Draghi again, that the euro is so strong. Of course, the Japanese yen will significantly devalue in the next couple of years. So everybody wants a weak currency, but against what will they devalue? Of course, against hard assets like gold, for example. So I think the fact that all the cycles when it comes to central banks, they are basically very much aligned nowadays. And it's no secret, important central bankers are meeting at the Bank for International Settlements in Basel every, I think, 6 or 8 weeks. And of course, they are discussing what's currently going on. But it's just a loser's game that they are playing. And I think the fact that the whole world believes now that the US is on the verge of a big new rate hike cycle, that's just a big joke again, because they're talking very, very hawkish, but they're acting pretty dovish. And I think that the chances for a recession in the US are much, much higher than the mainstream sees at the moment. We ran a great chart in our last In Gold Week Trust report based on the most important economists that are surveyed by Bloomberg. And out of those 89 economists, the smartest mathematicians, rocket scientists, economists, whatever, nobody is expecting a recession in the US for the next 3 years. Out of 89 people, nobody is seeing a recession in the next 3 years. And this is especially interesting as we are seeing rate hikes now, and we have seen in the last 100 years, out of 19 rate hike cycles, 16 ended in a recession. And I think we are seeing one of the longest economic expansions. So it's pretty interesting that nobody is expecting a recession going forward, besides some followers of the Austrian school. And I think that the big money will be made when this consensus changes. So when fears come up that, okay, recession might be around the corner, what will happen? Of course, the Federal Reserve will have to reverse. They will have to change their communication policy. They will have to say, okay, perhaps we will lower rates again. Perhaps we will introduce a new round of quantitative easing. This will be a massive catalyst for markets and especially for gold. So from my point of view, this will be the biggest catalyst for gold going forward, recession fears coming up.
Yeah, we have, like you said, using government numbers, have unprecedented amounts of economic expansion. And if the Federal Reserve does start to increase interest rates even further, that would send a message to asset markets that they would want them to the asset markets to cool off and probably fall. But I'm not sure how long they would want the asset markets to fall, considering how much global debt there is and how leveraged a lot of the people holding these assets are. We are seeing the government economists aren't warning about the recession, like you said. A lot of people aren't expecting that, but we are seeing some warning signs. We've had Lloyd Blankfein, CEO of Goldman Sachs, and also the CEO of Deutsche Bank recently warned that there's a lot of asset prices have been going too high, too much, without really any corrections, which are normal. And then there's inflation, there's asset price inflation in the capital structure of a lot of bond markets and other funding that really hasn't been there in the past.
Yeah, I mean, I totally agree. There's one brilliant chart that I tweeted out today. It's by Deutsche Bank, and it basically says all. It shows the aggregated 15 developed market country averages for bonds and equities. It's at the most expensive level since 1925. So since 1800, there has never been any environment where bonds and stocks were more expensive. Of course, this goes hand in hand with low rates, definitely. But it also shows you how crazy this environment is. Just to give you another number, in the first quarter of 2017, the biggest central banks printed 1 trillion money out of thin air, basically. And of course, this leads to stock markets going crazy. This leads to real estate bubbles. This leads to bubbles in the art sector, in so many different areas. As soon as the momentum of that slows, and of course there's some sort of a time lag, but as soon as that slows, this will have significant impacts on financial markets. And of course, the next round of quantitative easing, due to the declining marginal utility, 85 billion won't be enough. It will have to be 150 billion, 200 billion per month. I don't know. But the big question is, the last big crisis was basically solved by central banks bailing out Wall Street. Before, basically the big banks, they bailed out LTCM. So the big question is, who will really be able to solve the next crisis that will definitely make 2008 look like a kindergarten party? I totally agree to Jim Rickards. He's also on our advisory board. He says the next stage will be the International Monetary Fund. And I think it's no coincidence that the IMF holds the second biggest gold reserves. And I think that within the next crisis, and I cannot forecast when it will happen, but it will happen. Within the next crisis, there will be some sort of a remonetization of gold. And then we're not talking about levels or 13 or 1400s. Then we're talking about $3,000, $4,000, $5,000, because as we're showing in our gold report, the gold backing of the US dollar is basically at the same level like in 2000. So, of course, the gold price rose since the year 2000, but there was also quite a lot of money printed. So therefore, actually, the nominal price of gold is still extremely cheap. And I think if you study monetary history, after every big crisis, gold took another role to restore confidence in the system.
Yeah, gold and silver are barely at the marginal cost of production right now, and they've kind of either hung at that price a little bit above the marginal cost of production or even below that the last couple of years as they've tried to find a bottom in price. I think those gold and silver prices are both manipulated. You just wrote an article for the Mises Institute recently about the U.S. losing the world reserve currency. You don't think the dollar is going to collapse against other currencies, though, because when people tell me the dollar is going to collapse, Peter Schiff has been saying that for a long time. I think Peter Schiff's a brilliant guy. I don't know what the dollar is going to collapse against. Is it going to collapse against buying consumer items? Is it going to collapse against other currencies? I don't think the dollar is going to collapse against necessarily other currencies per se, because it seems, all these exchange rates, Ronnie, are being manipulated and coordinated where, if one currency falls too much against another currency, the central bank goes in there and tries to manipulate it. But, I think what this is causing is a lot of stagflation and trillions in misallocated capital from all these governments trying to do this into the global supply chain. So whether it's China, the United States, or others trying to do this intervention of central planning policy, managing their exchange rate, the either intended consequences or unintended consequences are, your bills are going to be going up, whether the inflation statistics say that or not. And you already mentioned the asset prices that have been soaring since the 2008 financial crisis.
Well, the article that I wrote for the Mises Institute is about the de-dollarization, and we had that in our last In Gold We Trust report. And I think there's quite significant things happening. First of all, it seems that the dollar is really weak since the beginning of the year, and this is exactly what Donald Trump wants, and he's quite vocal about that. He says that the dollar is way too strong, that for his reindustrialization he actually needs a weak dollar. And therefore, gold in US dollar terms is up almost 14% since the beginning of the year. I would say that pretty decent performance. So in dollar terms, it was the best performing. Gold was one of the best performers since the beginning of the year. I think that there's just for the big picture, and this usually takes years or even decades from one reserve currency to another one. I just sense that there's quite a lot going on, with the Chinese trading their oil in renminbi. There were quite a lot of contracts between Saudi Arabia and Chinese, between China and Russia. there's quite a lot going on. The infrastructure for the Shanghai Gold Exchange is getting more and more important. Their oil contracts are getting more and more liquid. Quite a lot of countries try to avoid dealing in US dollars anymore. And I think the issue of a global reserve currency is really important. And therefore we dedicated quite a big chapter to that topic in the last report. Of course, I think this process of moving away from the dollar, prepared by Europe and triggered by China and Russia, it cannot longer be stopped. And as a supranational reserve asset, from my point of view, gold plays an important role in it. And the fact that Judy Shelton, who is an economic advisor to Donald Trump, is also so vocal about sound money, the fact that the vice president is so vocal about sound money and commenting on gold and its role in the monetary system, I think those guys really know what's going on. You know, the US still holds by far the biggest gold reserves with more than 8,000 tons. So I think sooner or later there will be a revaluation of gold, and this would solve quite a lot of problems, of course.
Yeah, I think the manipulators will have to let the gold price rise to a certain point, at least so the primary gold miners are allowed to economically replace their reserves. So at the minimum in the near future, we're going to have to see $1,400, $1,500 gold in the near future. Otherwise, a lot of the gold miners in a couple of years are going to have mined all their economic gold reserves. But I want to ask you, since you're a hedge fund manager, superstar billionaire hedge fund manager Hugh Hendry essentially was just fired from his global macroeconomic fund. He's lost some money, a lot of money, percentage terms, I think 9% down the last couple years. You know, he was well respected in the community, had made a lot of money after the 2008, during and after the 2008 financial crisis. He said basically his models are broken with what the central bankers have done. Do you think, based on the interventions and the modeling, that you can't really do any models anymore with what the central banks are doing and all the intervention?
An enormous amount of respect for Hugh Hendry. He managed a very, very successful hedge fund for I think 15 years. He generated great trade ideas. He's very, very well-read guy. So I thought that's really interesting. I think that of course with volatility being so depressed, with markets working in such a unnatural way, I think it's really, really hard making money. And it's not only hedge fund guys, it's also trend following strategies, CTAs that are suffering. And normally, as one of my trader colleagues once told me, he said the market is a pain maximizer. And I think we haven't seen maximum pain yet. The fact that a star like Hugh Hendry quits, I think this is already a very, very strong sign, and probably says that we might be close to maximum pain. But I think, of course, it's a very, very tough market to trade. We have also traded on a short side with very, very limited risk budget, but we've lost on that trades. It's a brutal market these days. It is.
Yeah, and Hugh Hendry doesn't see the world as you and I see it. I don't think he believes in Austrian School of Economics at all. I think, in fact, actually, like I've heard him make fun of Grant Williams, who's a libertarian, about the Austrian School of Economics, and making fun of him for holding any gold for so many years.
Yeah, I've seen that interview on Real Vision as well. Honestly, with his views since 2011, it wasn't a good trade being long gold. We have to be honest. Yeah, other asset classes did much better, but that doesn't mean that it will be a bad trade going forward. I think that I don't know if he knows the Austrian School of. I think he knows about the principles, but he doesn't see any edge. Having an Austrian world view with his global macro view. But yeah, I'm not sure if he really regards gold as a currency or just as some sort of asset. I really don't know.
Well, you mentioned the volatility trade and how there's really no volatility. I don't know if you saw this article last week, but Christopher Cole, who's of Artemis Capital, he has a $300 million volatility hedge fund, and he researches the volatility markets a lot because that's all he trades, and he has white papers out. And he said in a New York Times interview last week that he thinks there's up to $1.5 trillion in short volatility trades that have basically piggybacked what the central banks are doing and use leverage to, and this is managed money, day traders, etc., that have all hopped on this trade. And so he was speaking to money managers who are short volatility, like either short the VIX or short doing short straddle trades. And basically they said they wouldn't put a dime of their own money into these trades, but because, they're managing money and they're expected to figure out new ways to generate returns, this is what they're doing. So this looks like, another economic landmine that the central banks, in order to keep asset prices high and keep gold prices down and try to reduce asset price volatility, that they've unintentionally helped create this next bubble.
Yeah, absolutely. I think what Cole said in this interview is that the fact that everyone has been incentivized to be short volatility basically set up this reflexive stability, some sort of a false peace. And I totally agree to that. And I really like the fact that he says that volatility is in fact the only asset class from his point of view. And I think that the problem is that you cannot depress volatility forever. It's the same like Ben Barbeck once said. There are economic laws and you have to respect them. And the longer you try to avoid them or depress or manipulate them, the stronger will come back. And I think that's the very same with volatility. Of course, that's definitely not something that we're focusing on. And Artemis is one of the most professional players in that sphere. I think going long volatility has been a trade idea for very successful hedge fund managers the last couple of months, but nobody basically won on that. I just saw an interview with Kyle Bass yesterday on Real Vision, and he also said long volatility is going to be the big trade. But this basically leads back to the Austrian school. Timing is really, really crucial, and I think once it will start getting rolling, I think nobody can stop it. But perhaps it's too early to go long volatility at these levels.
Yeah, it just seems that every time the volatility spikes, like with the first, North Korea missile launch, the VIX spiked a lot, and then it went right back down. It seems like the leverage money that was still short this volatility trade just doubled down further and continued to pile on because they need this to work out. I don't know about you, but I've heard a story of a day trader who's just been shorting the VIX, and I think he turned $500,000 into after 2009 into like 12 million in like 7 years. Yeah. So it's crazy how much this short volatility trade has worked. I mean, look how much the stock market is up since the 2008 financial crisis. Absolutely. And you mentioned the bond markets and real estate. And this is the Cantillon effect. For our listeners who are not familiar with that, that's an Austrian school concept. The Austrian school actually technically wasn't even invented, right, when Richard Cantillon was alive. But, a lot of Adam Smith's writings, I think, are based on Cantillon. Yeah. And what he said that the money would first, if a central bank or government printed the money, it would first go into the hands of either the government or politicians, and then the people in the banks or financial industry. Absolutely. And I think this is actually what we're seeing these days. Hayek complained that to pouring honey, it spills out very, very slowly. And the fact, you just have to open your eyes and go into a big city, a big financial center. Those are the places where real estate prices are the highest. Those are also the places where people profit from monetary inflation most. And I think it's no coincidence that in every town around the world, in the city center, at the most expensive places, there are always banks and insurance companies. So those companies that are profiting from monetary inflation, they're always in the center. And that's no coincidence, because they are just the earliest receivers or producers of monetary inflation. And I think this is really, the Cantillon effect is really a very, very important point to understand. And it's also something that I always try to explain when it comes to inequality. Many people think that socialism is the answer to inequality that is, of course, increasing.
But I think we have to dig deeper and we have to discuss our monetary system, which is the true root cause of inequality that we're having at the moment.
Exactly. We don't have real capitalism now because the politicians and the central banks are not allowing large corporations or banks to fail. So you can't have capitalism without, wages and prices clearing and the market being allowed to basically reset itself, which means, falling deflation is actually healthy for the economy. Bankruptcy is actually healthy in the long run. In the short term, obviously, people lose their jobs. There's a lot of pain. But, in the long run, this is actually healthy. But what we have now is the exact opposite, and none of the healthy things in the past that would have been allowed to occur are being allowed anymore.
Yeah, I mean that's the same with recessions. People always they think I'm crazy when I'm saying that a recession is in the cards and that it actually would be something positive because it reallocates resources and it makes the system more healthy. But the longer you avoid that, the more drastic the reallocations will be. So I think this is also one reason why followers of the Austrian school are often blamed to be pessimistic and negative about everything. I think we are just more sensitive to misallocations of capital and bubbles, and I think nobody really enjoys being in a bust. We know that this is also the basis for a more robust upswing that follows. And I think that the fact entrepreneurship and the businessman is very important to the Austrian school as well. And even though we are seeing so many misallocations and things going wrong and more political and monetary interventions, I think that technologically there's so many positive things happening. We're seeing the whole revolution in the cryptocurrency space that is really disruptive. We're seeing the whole blockchain technology that is really disruptive for many industries, like the banking industry, the insurance industry. So there's lots of innovation happening, and Murray Rothbard always said pessimistic in the short run, but very optimistic in the long run.
And the people who call Austrians, overly pessimistic, I would just say they're more realistic. So it doesn't mean just because you can identify a bubble as, misallocation of capital and artificial doesn't mean you can't ride the bubble up. It just means you have to have the plan to exit, which most people, when they make a lot of profits, they ride the thing back down. So they don't take profits when they should.
Absolutely. Totally agree. Absolutely.
I want to ask you, since you live in Europe now, how the European economy is doing. Is lots of capital flowing into Liechtenstein, or is there a housing bubble there? Is there a lot of huge bank towers and insurance companies going in there? Like here in DC, where there's construction cranes everywhere. I hear in New York City there's construction cranes everywhere. There's housing bubbles in Toronto and Vancouver. Is the same thing happening where you live in Europe?
Not really. I think Liechtenstein, we shouldn't forget it. It's a country with 36,000 people, so it's not really big, but I really enjoy doing business in Liechtenstein, and we chose it because the Liechtenstein family, they are very libertarian. They know the Austrian school very well. I think the constitution of Liechtenstein is brilliant. It's one of 5 countries without any debt. It's a great place to do business. The banks have got equities ratios at, I think, 25%. It's really high. So I think from a banking perspective and a financial service industry perspective, it's probably the best place to be in Europe. In general, what we're seeing also in Austria, which is my home country, we're having elections like in Germany in the next couple of weeks. It's getting more and more extreme on the right wing side, but also on the left wing side. We are seeing populism on both sides, and I think this is no coincidence. And we were actually not surprised that Donald Trump won the elections because it's just a consequence of the economic situation, and therefore, of course, at the moment we are in Europe in some sort of a sweet spot. but we shouldn't forget that the ECB is basically buying everything they can, that they're doing a massive QE. They are not really able to get out of this QE because the euro would get too strong. Then this is what they fear. So therefore, it's no coincidence that most economic numbers are improving, that real estate markets are going crazy, that stock markets are doing well. This is just a consequence of massive monetary inflation. And therefore, as soon as this liquidity supernova creases and comes back, I think we'll see massive corrections in most markets. But at the moment, everything is in, as they say, in Goldilocks scenario.
And the ECB shouldn't have been allowed at all, according to their charter, to monetize government bonds or corporate bonds. And yet, look, they're monetizing a lot of them.
Yeah.
So, I mean, yields on a lot of, I think, junk bonds are lower than either, I think, the U.S. Treasury, on the yield curve now. That's how much the monetization of the ECB has impacted the bond markets.
Yeah, it's absolutely crazy. It's totally right. Junk bond has got lower yields than U.S. Treasuries these days. It's completely insane. The Austrian government just issued a century bond, which was massively oversubscribed, of course. I think with the yield of, what was it, 2.3%, something like that. Of course, if I was a politician and I would be the Minister of Finance, that's a pretty smart move, because then you're just waiting for inflation. And as we all know, that they're quite open about that. They want more inflation, and Janet Yellen said that you can occasionally get inflation higher than the 2%, but it's just a dangerous game. And I sat on a panel with a central banker quite recently, and she said there's no inflation. I said, I'm sorry, but you're wrong. There's massive inflation. There's asset price inflation. There is no price inflation that you try to measure with your kind of weird baskets. And inflation is always highly subjective, because my inflation, the goods and services that I'm buying, is quite different to the ones that my parents or grandparents buy, of course. So from an Austrian point of view, it's pretty nonsensical to calculate price inflation that way. Anyway, the fact that central bankers do not regard asset price inflation as something negative already shows that they will, of course, not see price inflation picking up. They will not be able to react to that once the genie is out of the bottle. And that's, from my point of view, and that's also what we are focusing on in our fund. Rising inflation, rising price inflation is actually the pain trade for every institutional investor, for every conservative portfolio, because it not only threatens bond prices, but also stocks. People always think that stocks are a great inflation hedge. They are not. It really depends on the sector. And what works best in times of rising inflation is commodities, is energy equities, is gold and silver. Those asset classes are performing best in times of rising inflation. And those are the asset classes that nobody cares about at the moment. I ran a great chart comparing the market cap of Apple versus the 16 companies in the MX Gold Box index. And I think just with the cash hoard of Apple, they could buy the 16 companies in the Gold Box index, which are the biggest gold and silver producers. They could buy them 2 times. So I'm just seeing a massive opportunity in those inflation-sensitive assets, because nobody at the moment believes in rising price inflation.
And I mean, basically, they have to, those central bank are the one, I don't know the one specifically you're referring to, but they all kind of seem that way, at least in public. God knows what they say in private, right? So, but it seems to me they're like ostriches that stick their head in the sand. I've actually looked into this with, the interns that they hire at the either at the Federal Reserve or the Bureau of Labor Statistics, and the interns they send out to Walmart or Target to write down the price, or the grocery store to write down prices of the items. The guy actually just writes the main prices on like a cereal box. He actually doesn't measure the cost per unit. So if the grocery company wants to, instead of giving you 30 grams of cereal and keep the price the same, if they want to drop it down to 20 grams of cereal, your cost of unit would be up. They keep the price the same, but you're getting, 33% less cereal.
Absolutely. Yeah.
And so they don't measure, they just look at the price. They would say, oh, the price hasn't changed, but the cost per unit is up, enormously. And they don't track that. And so then they play other games, like you said, where if the cost of an item is rising too quickly, they just pull it out of the basket they're measuring.
Yeah. There's not only this shrinkflation, but there's also deteriorating quality. I think this is also something that people tend to forget. Perhaps the prices may stay the same, but the quality in quite a lot of products is deteriorating quickly, and that's also a consequence of inflation.
Exactly. And so they won't acknowledge this asset price inflation in public, but that's what's really creating this wealth disparity. So it's not free market capitalism that's creating the wealth disparity, because if we had a lot more real free market capitalism, there would be more entrepreneurs, people who had small business. There wouldn't be as much taxes and regulation, and people. There's a lot of small businessmen out there who are scared to hire full-time employees for a lot of different reasons. So if there was more free market capitalism with less taxes, rules, and regulations, the economy would grow and it would create more high-paying full-time jobs. But instead, what we have is these politicians and central bankers that are creating larger and larger wealth gaps with market interventions because of the higher asset prices. Because the average guy on Main Street, doesn't have a large stock portfolio. Maybe they own their own house and they have a little bit of money in their 401k, but they don't own a large stock portfolio and real estate holdings all over the globe and a bond portfolio like high net worth people do.
Yeah. I couldn't agree more, Jason. You're totally right.
Yeah, so I think, we're going to have I think stagflation is already here, whether the government statistics say it or not, and I think it's going to get a lot worse before all this is said and done. Maybe we do have worse than a 2008 financial crisis, but what's going to stop the central bankers from just changing the rules and then coming up with a new way, whether it's the SDR or issuing a new dollar or whatever, some other type of new liquidity system, from starting this inflation game all over again?
The thing is, I think from studying history, as I've said before, every time a new currency was implemented, it was needed that there's some sort of trust, and gold always provided this trust. It was the same with the euro, for example. When they introduced the euro over here, there were big campaigns and they were showing that the euro is based by the gold reserves in the euro system, which is more than 10,000 tons of gold. And this also brought some sense of stability and trust in the euro. So this makes me pretty confident on gold. I think that, having this Austrian world view, it also makes you kind of better prepared for more extreme scenarios, for financial repression, for a big crash, for I don't know, big taxation or cash bans, whatever. This is also something that what we see at the moment. There's much more need for geographical diversification. Back in the days, people held their gold in Swiss banks. Now they're diversifying it. They're holding it in Australia, New Zealand, in Liechtenstein, in Singapore, in Hong Kong, and in the US, whatever. So there's quite a lot of happening when it comes to geographical diversification, because people are just losing confidence and trust in the government, in institutions, in the media, and so on.
Exactly. Well said. Well said, Ronnie. There's so many problems in society, and I think, a lot of it starts with the corruption in governments and money, and that's from Wall Street and the central banks. I mean, look, people who voted for Donald Trump, I don't think they suspected that he would be getting the majority of his advice from three, Democrat Goldman Sachs bankers. So, but I want to thank you for your time today, Ronnie. And if our listeners want to read the next In Gold We Trust report or buy your book, how do they do so?
Well, just visit our webpage, incrementum.li. Just Google it. You can also Google In Gold We Trust. All our reports are for free. We've got an extended version with more than 160 pages about gold, about inflation, about gold stocks. Very, 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 very interesting and I think thought-provoking read. We also got a compact version. We've got a new journal on our webpage with all our publications. I'm pretty active on Twitter. It's Ron Stoferle. is my Twitter handle. And yeah, I'm looking forward to being on the show again. And we also got the book, Austrian School for Investors. It was really, really successful in the German-speaking world. Now we got the English translation that is, I think, even better because we added a few chapters. I hope that you and your listeners enjoyed hearing my views.
And I'll post a link to go buy the book, to go buy the Kindle or the hard copy. But maybe you can also have an audiobook released in English in the near future.
Yeah, I'd love to.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube/Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.